The rapid reopening of the economy has brought a sharp run-up in inflation. Over the 12 months through July, measures of headline and core PCE inflation have run at 4.2% and 3.6% respectively, well above our 2% longer-run objective. Businesses and consumers widely report upward pressure on prices and wages. Inflation at these levels is, of course, a cause for concern.
But that concern is tempered by a number of factors that suggest that these elevated readings are likely to prove temporary. This assessment is a critical and ongoing one, and we are carefully monitoring incoming data. These effects, which are adding a few tenths to measured inflation, should wash out over time. In seeking to achieve inflation at average percent over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting. I guess to answer your question a different way, is there a risk that inflation will be higher than we think? Yes, as I said earlier, we don't have any certainty. The concept of transitory is really this. It is that the increases will happen. We're not saying they will reverse. That's not what transitory means. It means that the increases in prices will happen. So there will be inflation, but that the process of inflation will stop, so that there won't be further. When we think of inflation, we really think of inflation going up year upon year upon year upon year. That's inflation. When you have inflation for 12 months or whatever it may be, I'm just taking an example and not making an estimate, then you have a price increase, but you don't have an inflation process. And so part of that just is that if it doesn't affect longer-term inflation expectations, then it's very likely not to affect the process of inflation going forward. So what I mean by transitory is just something that doesn't leave a permanent mark on the inflation process. Again, I don't mean that producers are going to take those price increases back.
We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals.
So what would substantial further progress be? I'd say we have some ground to cover on the labor market side. I think we're some way away from having had substantial further progress toward the maximum employment goal. I would want to see some strong job numbers, and that's kind of the idea.
You want.
All right. Today is Sunday, August 29th. This is a recap for the stock market activities last week and an outlook for the week to come. In focus tonight, we will continue to build on the intro of this video. What else? The mental gymnastics, the bullshit out of the mouth of Fed Chairman Jerome Powell. Of course, the decision out of the Jackson Hole Gymnasium, whatever, is no taper, as expected, and the reason is FSP was not met yet. What is FSP? Further substantial progress. Here's Jerome Powell.
We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance.
Now, Powell says that FSP, further substantial progress, still needs more progress to be met when it comes to inflation and full employment. Because remember, their mandates are full employment and quote-unquote price stability. By price stability, the Fed means propping up, inflating, and ballooning the prices of assets in the equities and real estate markets, aka the assets of the wealthy, because that's the real mandate of the Fed. The Fed's real mandate is to prop up, preserve, protect, and inflate the assets of the wealthy, equities and real estate. But he says we don't have enough substantial further progress in inflation and employment. But what is this, Mr. Powell? The core PCE, this is the Federal Reserve main inflation measure. This is what the Fed uses to measure inflation in the economy. Core PCE. And the reading we got the same day that Powell came out and did the mental gymnastics of no taper, the number we got in core PCE is the highest in 30 years. Inflation is rising at the fastest pace in 30 years. But Powell says further substantial progress is needed on inflation, aka price stability, whatever the that means, and full employment. Okay. The Federal Reserve favorite measure of inflation rose to its highest level since 1991 in July, the Bureau of Economic Analysis said Friday. The price index of American consumer spending, also known as PCE index, rose at a rate of 4.2% in the year ended July, the fastest pace since January of 1991. Stripping out food and energy items, the prices of which tend to be more volatile. You know, we gotta strip food and energy prices out of our formula because food and energy prices don't matter to the consumer at all. And when we do that, inflation index stood at 3.6%, flat from the month before, and remaining at its highest level since March 1991. So even with the manipulation and the cooking of the data, inflation is still at the highest level since 1991. But hey, where is inflation, right? Is it here? Is it over there? We need more FSP, further substantial progress, whatever that is. Inflation has been a hallmark of the pandemic recovery. The reopening, along with global supply chain issues, are making things more expensive. But Americans' incomes rose as well in July, climbing more than expected. Yay! Albeit still not as much as prices. Incomes rose by 1.1% last month. Here it is, boosted by increased government benefits and higher wages. Benefits from the child tax credit payments under the American Rescue Plan offset waning unemployment benefits as various states ended their pandemic jobless claims programs early. It was the biggest jump in income since March, when the latest round of stimulus checks bolstered people's wallets. The trend was the same for disposable income, which also rose 1.1%, the most since March. And of course, inflation is rising all around us, whether it is car rentals, used cars, gasoline, beef, poultry, appliances, energy, fruit, pork, seafood, apples, haircuts, even TVs, electricity, everything is rising higher. What's declining in value, in prices? Men's suits. Men's suits down 20%. So Jerome Antoinette says, let them eat suits. Let them eat briones. What about home prices rising at the fastest pace on record in history? And now we have the lowest affordability rate in history, where the growth in home prices outpaced affordability for most Americans. Even the White House is doubling, more than doubling, their inflation outlook. And when it comes to FSP, further substantial progress in quote-unquote full employment, whatever that means, of course, Jerome plays the mental gymnastics. Full employment could mean 2.5% unemployment rate. It could be based on genders and racial groups. I can't give you a specific number, a specific parameter on what full employment means. Jerome likes to keep it vague, likes to play the mental gymnastics. Why? Because his job is to continue to prop up, preserve, inflate the assets of the wealthy, stocks and real estate. And he will continue to do that until he is forced to cut the so-called accommodation policy for Wall Street. But even when Powell talks about full employment, what do you mean by full employment, Powell? Because we have the lowest weekly jobless claims since the pandemic started. We have over 10 million jobs open right now to be filled. Even other Fed members and Fed presidents are now sounding the alarm. The St. Louis Fed President James Bullard says that perhaps tapering has to be quote-unquote aggressive because inflation is getting out of control. But Powell continues to ignore all calls, even within his own Federal Reserve circle, because once again, his job is not to serve the American public. His job is to serve the 1% on Wall Street. And I am comfortable enough at this point to call this man a psychopath. He lacks empathy. He can't even relate to the suffering and the plight of the poor and the middle class. The man is conniving at every press conference. He continues to weasel his way around, not answering questions fully, keeping every forecast vague. He is indeed conniving. He knows the harm that his policies will do to the poor and the middle class and to the future generation in this country. Yet he continues to beat on the same drum because the man is a psychopath. And of course, he has a higher job success. He is the best Fed chairman ever in history, according to Wall Street. And the reason is he made them more money than all past Fed presidents, Fed chairmen combined. This is the greatest era that Wall Street has ever had under Powell. I mean, think about it. 2 blocks from the Fed, the Federal Reserve building, which Jerome Powell attends every single day. 2 blocks. And he admitted that he sees the homeless camps 2 blocks from the Federal Reserve building. He knows what his policies are doing to the poor and mid-class. He knows what his policies are doing regarding home affordability and the homelessness crisis. Yet he continues to ignore all of that, continues to convince himself that his policies are actually helping the poor and the middle class. This is the definition of a psychopath. More mental gymnastics from Powell.
We also assess whether wage increases are consistent with our 2% inflation goal over time. Wage increases are essential to support a rising standard of living and are generally, of course, a welcome development.
So he says that the increase in wages, meaning wage inflation, because this is a side effect of inflation, wages will also rise higher, be it at a slower pace than the rest of inflation, whether it is in goods or services. Yet he describes this as some sort of a progress, an improvement to the standard of living. But are wages really rising higher when you factor in inflation? Studies show that the spike in wages have already peaked, while inflation continues to rise higher. Studies show that the growth in wages is being outpaced by core PCE, meaning that inflation is outpacing the growth in wages. CNN says inflation wiped out American pay raises. Politico says price growth is winning the race, and inflation is devouring wage gains. Fox Business says real wages shrank 2% in June. And this is the reality, by the way. On paper, wages are rising. But when you pin the increase in wages against the increase in inflation, the majority of Americans have now lost wages due to inflation. Our wages went down across the spectrum, by the way, as inflation continues to surge higher. And remember, Powell says prices will not go down. This is not what we mean by transitory. We mean that the pace of increase will slow down at some point. When? We don't know, but prices will continue to linger higher. Meaning, if the growth in prices this year outpaced the growth of your wages, you're stuck with that difference. Your purchasing power went down. Your standard of living went down. If your rent increased 20% this year, and then it increases at, say, 5% next year, according to Powell, inflation is transitory. But now you're stuck with paying an extra 25% in rent with an increase of 5% the next year. Meanwhile, your wages only went up higher by 2 to 3%. Meaning your standard of living went down because your expenses went higher. Continuing with the psychopath.
But if wage increases were to move materially and persistently above the levels of productivity gains and inflation, businesses would likely pass those increases on to customers, a process that could become the sort of wage price spiral seen at times in the past. Today, we see little evidence of wage increases that might threaten excessive inflation. Longer-term inflation expectations have moved much less than actual inflation or near-term expectations, suggesting that households, businesses, and market participants also believe that current high inflation readings are likely to prove transitory, and that in any case, the Fed will keep inflation close to our 2% objective over time.
And here he is again. This is all false. It's all garbage. He says that inflation expectations are tampered right now. Businesses are not complaining. They're not expecting higher inflation. Businesses are not passing the increase in wages to the end customer. This is false. Flat out lies. Here's from Axios. CEOs sounding the alarm regarding inflation. Every earnings call that we got in this earnings season, companies' CEOs, CFOs continued to sound the alarm regarding inflation. And every company said, we're approaching this inflation as permanent. We're not approaching this inflation as transitory. And therefore, companies are passing the extra cost to the end customer. Powell says they're not doing so. The truth says they are. In addition to all of that, small business optimism is waning down. And the reason is they're having a hard time hiring people. There is a massive labor shortage. And while public companies, fueled with the free cash printed out of thin air from the Fed, which they're using for share buybacks, by the way, they can afford the increase in wages. They can afford to compete in increasing wages and attracting talent. But when it comes to small business, which the Fed and the government could care less about, we're seeing, ladies and gentlemen, we're seeing the wipe out of small businesses across the country. They're closing down. It's not worth it anymore. And of course, who's going to take the spoils? The BlackRocks, the Blackstones of the world. Perhaps it's a part of a plan, a bigger plan. But again, Powell says the increase in wages is so far so good. It is increasing the standard of living. That's false. And he says that the increase in wages so far is not harming companies and they're not passing costs down to the end customer. This is all false, all lies, as I just showed you. And by the way, why is he sniffing all the time? As he just snorted something, by the way.
One reason why we now monitor inflation expectations so carefully. That brings me to...
Now, when it comes to Coke Man, we know that he is a professional liar. Everything that comes out of his mouth is a lie. The man is a psychopath. And even his own circle, other Fed presidents, from Kaplan to Bullard to George to Waller to Harker, all sounding the alarm. This is the time to start tapering. And he knows, even though he played this mental gymnastic on Friday to prop up the stock market, he knows that he will be forced to taper because inflation is getting out of control. But here is the Powell touch, the Pinocchio touch. This is his insurance policy. That even if we taper, folks, don't panic, calm down, stay in the casino, put your blindfold on, and continue to buy. Because the party's not over yet, even when we taper. Why? Because we might taper, but we will never raise interest rates.
The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis.
Now, if you watch the entire speech by Powell on Friday, he says that FSP further substantial progress has been met when it comes to inflation, meaning that inflation is rising and surpassing the 2% target for the Fed. But we have not yet to reach FSP further substantial progress when it comes to full employment. Then he does a 180 right away when it comes to interest rates and says, you know what, our FSP standards when it comes to raising interest rates are more stringent. And perhaps we haven't even met the FSP requirement when it comes to inflation because we need to see inflation rising higher above the 2% target for a period of time. What is the period of time, Mr. Powell? He doesn't know. He's just going to leave it open. Are you using any formula, Mr. Powell? No, he's not. And when it comes to full employment, if the FSP standard was not met to taper, even though we have over 10 million jobs open right now, then can you imagine what the standard is, the FSP standard for full employment when it comes to raising interest rates? Perhaps when we have 100 million jobs open, Mr. Powell? Again, this guy is a psychopath. He's a liar. He has no moral compass at all. And his recklessness will take the economic future of this country and the globe, by the way, on the path of destruction. And by the way, listen to Steve Leisman out of CNBC and how he described Powell's position.
But he's out of step, Carl, with at least some members of his committee there who are much more concerned about inflation, who have come on our air in the last several days, including this morning, and said point blank, we see the inflation issue as less transitory. If there were a motion to describe what Powell did, it's this: with his chips when it comes to going all in on the transitory story when it comes to inflation.
So Powell goes all in. Is he going all in with his own dough? Is he going all in with his financial future? Is he going all in with his own dime? Of course not. He's going all in with America's financial future. He's going all in with the future generations' prospects of financial prosperity. He's going all in with the standard of living. And of course, Powell can afford to gamble with our future. And the reason is he is the richest Fed president in decades. He has tens of millions of dollars in net worth. If he up and we have a historic inflation crisis that perhaps lasts for years and years, is this man going to go to prison? Is there any price to pay here? Or is he going to sail away to retirement and enjoy the tens of millions and millions of dollars that he has? All right, enough talking about this lying, conniving, psycho piece of shit. Let's move on to talk about charts, shall we? And here we go, starting with the SPY 30 minutes chart. What do we see here? We talked about the double bottom on Thursday, and I said that the action stopped right at the double bottom due to the closing bell. So we couldn't find out whether the double bottom will hold or not. So we had to watch the overnight charts in the futures. And they indeed did hold the double bottom. Of course, these things leak ahead of time, and it was a no-brainer to begin with that Powell will not taper, will not announce the tapering at least. And this is exactly what he did. And as he started to talk, you saw the crash in the US dollar. Combine that with muted to down activities in the 10-year yield, and if you followed my guideline that I shared with you ahead of the start of the week, you would have done just fine. Because all in all, throughout the week, the dollar was down and yields were trading down to flat. There was one day when the dollar and yields spiked up higher, and that was Thursday, and therefore we had a down day in the market. But besides that, following this guideline was immensely helpful. When the dollar goes down, hand in hand with yields, specifically the 10-year yield, this is the greatest environment for stocks, commodities, even gold to rise higher. The SPY is no exception. What do we do here in this chart? We have strong support right now at the double bottom. So any pullback will be met with a reaction at the double bottom. The chart is extremely strong right now. We have a confirmation from Powell that tapering will not happen, at least not for now. So the market has the green light to conduct an impulsive rally higher, what I would call the last hurrah rally. When we switch to the daily chart of the continuous contract, as you can see, we have a defined trend with pullbacks as the chart diverged by about 3 to 4%. As we stand right now, the current divergence is around 3%. So it is around average. If we do have a last hurrah rally, as we saw back in the August 2020 rally in the NASDAQ, then the expectations are this pop higher, this divergence from the trend line will exceed prior divergences, which means that the SPY could add another 2 to 3% gains in a short amount of time, and this would be the last hurrah rally before we see a massive pullback right down to the trend line and perhaps breaching the trend line. But what if the chart stops at the average, 3 to 4% divergence? and it pulls down to the trend line. This is what I'm watching for in this upcoming week. Folks, for all the shorts and the bears out there, do not short this chart at all until and unless the trend line and the support line of 4,384.5 are breached. Other than that, you have no confirmation at all, and the trend remains intact. The momentum indicators are now trading positive, indicating that there is momentum in the move in the SPY. Of course, you always have to keep in the back of your head that what we saw on Friday is a knee-jerk reaction. And perhaps the market had the weekend to digest what Powell said, because Powell did not say he will not taper. He said he's not announcing tapering, but he is keeping all possibilities open. The likelihood is, reading between the lines, he will be forced to taper in October because other Fed members are increasingly becoming more anxious and more worried about the rise in inflation. They will push Powell to announce the tapering in September, and perhaps tapering will start in October. They say that they will give us advance warning, whatever that means. And of course, Powell has the insurance policy that yes, folks, don't panic here if we taper, because yes, we might taper, but forget about raising interest rates. So we will see how the market reacts at that point. Of course, we have the seasonality that September is the worst, historically speaking, is the worst month in the stock market. Will the seasonality hold this time around, or will it be defied as we have become accustomed in this mania hyper bubble of a market? We will talk in the conclusion of this video. What about the Qs? What's going on here? 30 minutes chart. The double bottom holds also in the Qs. We see a massive pop higher. Nothing to see here. It's a bullish consolidation. Any pullback will be met with strong support at the double bottom. This is the daily chart for the continuous contract in the Qs. The momentum indicators are now positive, believe it or not. The chart is trading well above 15,000, and there is nothing to see here. You have a bull flag consolidation that is playing out, and we have a breakout higher. Now, when we look at the Qs itself, not the futures, but the Qs, the daily chart, we know that we have a massive divergence right now that's been going on for months and months and months from the trend line. Back in August, the last hurrah rally, we saw a massive divergence from the trend line and then a pullback, and that was the end of the trend right there. We had another trend being formed. And of course, the Qs, by the way, understand this, right around October and November, the Qs were ready to trade down, but the entire market was lifted via the Biden optimism. More stimmies, more accommodation, etc., etc. And we saw the Qs riding on a new trend. It's been at least couple of months right now, if not more, with this divergence of the trend line. The rationale, history says that we will see a pullback. When will that happen? It's anybody's guess. But the divergence is becoming steeper by the day. What does that mean? It means that the pullback all the way to the trend line will also be steep and aggressive. For now, you have no signal at all that we're about to do that. So the assumption is the last hurrah rally continues until it stops. This is a chart of the IWM 30 minutes chart. It has been battling the resistance level of 223 over and over and over and over again. And finally, on Friday, the IWM blasted higher. What do we read from the surge and the outperformance of the IWM versus the SPY and the Qs on Friday? The market, in essence, is saying that the reopening / the inflation trade is now in favor, because you have the Fed chairman himself, Powell, allowing inflation to continue to rise higher. He's not going to taper at least for 2 more months, a minimum, which will allow inflation to continue to rise higher. Assuming that Delta gets under control, then the market's assumption of the outperformance from the reopening / inflationary trade is indeed correct. And we will see higher highs in the IWM. The resistance right now at 229, the support at 223. Any pullback, watch out for 223 if it holds or not. The likelihood is it will hold, and it will be extremely difficult to break at this point. The chart of the week, the Dixie, what's going on here? It was a down week for the Dixie. It was announced ahead of time. The moment the Jackson Hole meeting was canceled, and Fed Kaplan, the Dallas Fed Kaplan, made the 180 from a hawk to a bull back to a hawk. We knew right away that Powell will not announce tapering, and therefore the Dixie goes down. But remember, the market is more intelligent than Powell and the rest. The market will look ahead and say, you know what, at some point he's gonna be forced to taper. What does that mean? It means that any pullback in the Dixie will not be sustainable. The Dixie could go down to 92, even 91, but sooner or later it will rebound higher. When it rebounds higher, it means that we're getting closer to tapering. In the meantime, a drag down in the Dixie will be extremely good for the market, specifically the inflation trade, oil, energy, materials, gold, industrials. All of these sectors of the market will benefit tremendously, assuming that the Dixie will continue to drag down. Here's the chart of gold. It was an excellent week for gold, rising higher. And now we're reaching the upper limit of the Fibonacci retracement level around 1,830. Again, if the Dixie continues to fall down, then the assumption is gold will rise higher. Of course, pay attention here. Gold has two enemies, actually three, but two main ones, the Dixie and yields. So if the Dixie goes down and the 10-year yield continues to trade flat, this is good for gold. But if yields, for whatever reason, pop higher, then we get a problem with gold, even if the Dixie continues to trade down. The third enemy, of course, is BTC, Bitcoin, but for now, gold is ignoring cryptos altogether. And here it is, the chart of the 10-year yield. What's going on here? The chart broke above 1.28%. The chart broke above the descending trend line of resistance, the slope. It is revisiting the slope. It is revisiting 1.28%. And if the retest is met with success, meaning a rebound higher, then we have a confirmation that yields have bottomed, at least in the 10-year, and we will trade higher from that point on. What does that mean? It means that perhaps you want to be in the inflation side of the stock market, not the technology and growth, because the Dixie could go down and then yields trade higher, and this will be good for the inflationary trade, but not necessarily for the NASDAQ and the big cap technology names. Matter of fact, this week, it was an excellent week for the market overall, but the big cap technology names lagged a little bit, specifically when we talk about Apple and Microsoft. This is a chart of the TLT bond prices, a weekly chart. Again, the battle continues. TLT trading at 149. If it starts to pull away from 149 in one direction or the other, then we're going to have a confirmation of what's going on in the market. I would pay attention to the chart of yields, the 10-year yield, not the TLT. The TLT is in a bullish consolidation, gathering energy to pop higher above 149. The real chart to watch is the chart of the 10-year yield. Watch the reaction of 128%. If the retest happens and we see a rebound, then you know the TLT will flush down. However, if the retest fails, then you know the pop higher in the TLT will happen. The VIX, what's going on here? We had a mini, baby, little pop in the MACD indicator. That resulted in, about 18% pop in the VIX. But now we have a pullback. Remember, we have a gap not closed at around 15. So as we see, assuming of course if we see the last hurrah rally in the SPY, then the VIX will flush down. The main question is, will the VIX flush down to violate the support of 15? If that is the case, then we will see a tremendous last hurrah rally. However, if the VIX bounces back after closing the gap, then perhaps that scenario, going back to the SPY's chart for the future, perhaps we will go back to the same divergence from the trend line, about 3 to 4% before a pullback. And we're not going to have a last hurrah rally. So watch the VIX here. See how far the flush down in the VIX will go. If it goes to 15 and rebounds back higher, then perhaps the SPY will also follow the trend, a divergence of 3 to 4%, and then it pulls back to the trend. If the VIX violates 15, then we're in for the last hurrah rally. Apple 30 minutes chart, what's going on here? Still within range. This is my indicator, by the way. It has not broken one way or the other. Support 145, resistance 150. Watch this chart. It's extremely important. Tesla, the souffle 30 minutes chart, what's going on here? The chart is still making higher highs and higher lows. So far, so good. It is consolidating in a bullish formation to gather some energy to break above 720 once and for all. The problem is this stock has been moved or been moving due to market manipulation via the options market. I showed you every Monday we have somebody, a mysterious entity, buying an enormous number of call options on Tesla. They pump it on Monday, they dump it Wednesday, Thursday, by the end of the week, and they move on. Lather, rinse, repeat. But now we have a mounting evidence of problems when it comes to the souffle. The latest is a crash in Orlando where a woman was driving her souffle on the full self-driving whatever, and she crashed into a police car. And this has been a pattern now, not just in the United States, but also in China. Will the news finally pull the chart down? We will see. This has been a Teflon stock, by the way, moving higher regardless of the bad news, regardless of the cartoonish valuation. We will see at what point does the straw breaks the camel's back. For now, Tesla riding higher. Tulips, what's going on here in BTC Ward? Nothing is going on. Looking at this chart, it made a tremendous rebound of over 70% in an ABC pattern. And now it is in consolidation mode. The technicals say that this is a sell it chart, not a buy it chart. What does that mean? It means if you bought BTC at 30,000, 40,000, this is the time to take chips off the table. But let's read the psychology here. After a massive pop higher, and they're contributing this pop, by the way, to the so-called whales, crypto whales, buying an enormous amount of BTC. We are now at a point where the buying is plateauing. The buying already happened. Will these buyers sell now that they have made a killing in a short amount of time, over 70% gains? If they do, then the chart will pull down all the way to at least 42,000. But for now, the psychology battle is the whales are waiting and waiting and waiting. Waiting for what? Waiting for retail to jump in and push this chart higher. The whales built the pop for you. Is retail about to follow up? If there is no follow-up, then the chart will not pop higher. Although there is the prospect, by the way, because this is a bullish consolidation. If retail follows through, then the chart will pop higher. If they don't, then the whales will say, you know what, we made 70, 60, 50%. That's enough. Let's take some chips off the table. And the chart goes down to 42,000. Perhaps that is a better price for retail to buy the dip. Perhaps right now, 48, 49,000, not attractive to the retail crowd. We'll see. Here's another retail favorite, AMC. What's going on here? Weekly chart. You don't need me to tell you this. 32 is the number to watch. The chart needs to trade at 52, and it needs to break above 52 as soon as possible, because doing so will make repairs on the weekly chart. If not, if the chart continues to trade within range between 32, 42, 45, back and forth, then the weekly chart will play out. 32 will be violated and we will see a flush down. Why is 32 important, by the way? Because it is the number that whales are paying attention to. Whales are waiting for the stock to shoot up higher. But if it violates 32, they will start taking profits off the table aggressively. That will leave you, the small retail investor, with your pants down. So you have to look at 32 and ask yourself a question. Does this chart have the energy to blast higher and break the resistance of 52? Or is the momentum, the best of the momentum, behind us? And we have more distractions now with support.com and other stocks, that the likelihood AMC will break 32. And if that is the case, then perhaps you want to take some chips off the table. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have pending home sales. This will be important regarding the health of the housing market. It will be important for lumber prices. It will be important for home builders, the likes of D.R. Horton, Toll Brothers, Lennar, etc. Then throughout the week, we have on Tuesday the Case-Shiller Home Price Index. This is extremely important, by the way. We have the Chicago PMI and the Consumer Confidence Index. All of these are important regarding the reading on inflation. On Wednesday, as we start a new month, we have the ADP employment report, we have the manufacturing PMI, we have the ISM manufacturing index. All of these will be important. But perhaps the most important reading on Wednesday will be motor vehicle sales. We need this number because one of the main arguments for the transitory crowd is that used car prices are transitory in nature. The spike is transitory. So we need to see if the activities in buying used cars, used and new, is also slowing down or not. Thursday, September 2nd, we have, per usual, the weekly jobless claims, and then we have factory orders which I consider important regarding the outlook for inflation and the demand specifically. And lastly, on Friday, we have the big one. Powell says, I'm waiting for FSP. Further substantial progress when it comes to full employment. He's waiting for hot jobs report to come. Will this upcoming report confirm that inflation is rising significantly higher and the pace of recovery is exceeding Powell's expectations, meaning meriting tapering in October? Or does it not merit tapering in October? Is the economy peaking when it comes to job gains? On one hand, we have Delta. The likelihood is Delta will slow down the leisure and hospitality hiring, which was spearheading the jobs growth in this economy. On the other hand, we have the unemployment benefits expiring in September. So are some of these unemployed people seeking jobs and filling some of these jobs as they realize that the enhanced unemployment benefits are about to expire. This is the battle I'm watching for in the non-farm payroll report on Friday. We will also have the services PMI and ISM indices. This will also be important regarding the reading on inflation. Anyhow, folks, this is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.